Good morning, everyone. Welcome to our first ever Zoning in Series. This webinar is a joint venture between Lambda Alpha International, or LAI for short, and California YIMBY. We plan to host one panel on new housing topics at least once a quarter, so stay tuned. My name is Rebecca Mervish, and I was the summer research fellow at California YIMBY this past summer, and I'm excited to be moderating this panel today, co-hosted by California YIMBY and LAI. So let's set the scene. California builds thousands of apartments each year. Almost none of them are condos you can buy. The financing doesn't exist. So developers build rentals instead, and aspiring homeowners compete for whatever existing condos are left and the few new ones that are built. We've all but stopped building for sale single family, townhomes, and multifamily homes, and the result is the second lowest homeownership rate in the country. California needs more for sale homes across the board, but especially in job-rich urban areas. With limited land for single family construction and few condos being built, homeownership has become increasingly out of reach. New home deposits could change this. There are protected down payments that fund construction before it starts. It's how other markets create ownership housing at scale. California just needs the legal and insurance framework to make it work here. Most of the world solves this problem through new home deposits, which are protected down payments that help finance construction rather than fuel bidding wars for existing homes. Today, we are learning from the following panelists to learn more about this new frontier of housing finance. If you have any questions throughout the panel, you can submit them in the Q&A box and we will try to get to them. So for our panelists, first we've got Mohammed Al-Meldeen, the Senior Policy Advisor at California YIMBY. Mohammed he leads the research efforts and helps shape the organization's future legislative priorities. His work focuses on advancing bold, data-driven solutions to California's housing crisis, looking beyond zoning to address deeper barriers to housing production. Mohammed and I have co-authored a paper on new home deposits slated for publication by the end of the year. Maya Theuer, Chief Executive Officer of Redwood Residential Development, which is a full-service suburban infill, multifamily, and BTR developer with focus on Northern California markets, Redwood sources and titles, capitalizes and builds low-rise rental housing. Maya graduated with a degree in mechanical engineering from Stanford University and is a board member of Stanford Professionals in Real Estate. Carrie Nagy is the Vice President of Underwriting, Travelers Canada. Carrie's been with Travelers since 1999 as the VP of Underwriting for their residential surety group. He has been involved in the creation of the Home Warranty Group in Western Canada, Deposit Protection Insurance in British Columbia since 2005, and more recently, the development bond product offering that required bringing municipalities to the table. And finally, Michael Lane, the State Policy Director at SPUR, which is a public policy think tank in the San Francisco Bay Area and has an extensive background in housing development, local government, public policy, legislation, politics, and campaigns. He has served on the board of directors of Housing California and the board of governors of the California Housing Consortium. Michael has worked in local government and held elected office as a school board member and city council member. So those are all our panelists. And now we can get started. Mohammed, do you think you could take a second to provide us a quick overview? What are new home deposits?
Yeah, definitely. And Leo, I just got on. My MacBook is now working from the update. Leo, are you in the same situation? And if you can you share the screen? If not, I can share the screen. Okay, I will do it. I do not hear you, but I will do
Oh,
it.
I could do it right now. My bad.
Oh, perfect. Thank you. All right, awesome. So this is a preview, some preliminary findings from Rebecca and I's paper on new home deposit reform. This is specifically focused on California. Next slide. Setting the stage, California has a severe housing shortage. New condominium construction is only 3% of all multifamily being built. Most homes that we're seeing are rentals when it comes to multifamily, for ownership for single family homes, but we do not have as much small development as we've had. I think small development has declined by about 50% in recent years. So we're seeing less home ownership opportunities in a state that is 49th in home ownership. So the lack of home ownership supply completely contributes to the lack of home ownership opportunities. Next slide. So, new home deposits, what are they? So, in most of the world, in some states in the US, you could, if you're a prospective home buyer, you could basically put down a deposit for new home construction. How does it work? Well, the developer would finish basically the process up and like after entitlements, and they have about a year's time to raise deposits from different home buyers. So basically, they would work with a realtor or they'd work on their own and find, let's say, a bunch of home buyers in the prospective market, secure the deposits, bond it, insure it, and use that money from deposits to help fund for construction. So what it does is that number one, it signals buyer commitment. Buyers can't back out if they have a deposit of, let's say, 20% for new home construction, which makes lending way less risky for banks. And at the same time, it provides developers some sort of security that when construction's done in, let's say, 3 years, that they know that there will be prospective people trying to buy. There are more benefits. We're going to go over it. But this was a comparative analysis of different states and different countries and how they use new home deposits to fuel new home construction. And it's seen as a tool to help de-risk investment, basically from banks to help fund more housing. Because just because we zone the product doesn't mean the project is feasible. But we're about to go a little bit deeper on that. Next slide. So, new home deposits in California right now, they are set at 3%. So the 3% of the home price can be used as a deposit from a prospective home buyer, but that cannot be used for construction. So it just sits in the bank. You have a deposit, sits in the bank, not used by the developer. It's not used to give you a discount on the home, etc. There were a few times of which this has been reformed or tried to be reformed. One successful attempt, which was in 2008, which raised deposits to 10% for large high rises, but the impact was minimal during this thing called the Great Recession. So now we have a 3% cap, the deposits are held in escrow, and little is used for construction financing. Next slide. So we created first two pro forma models, one in the San Francisco Bay Area, one in San Diego, to see what is the impact that new home deposits would have. Right now, banks loan about 60% of a construction product, maybe 70%, and the rest is covered by equity. Equity means pension funds, private equity groups, wealthy individuals. It's really the cheapest debt is bank debt. The most expensive debt is equity. And equity expects higher returns and they expect home prices to be sold at a higher rate so they could be paid back. What this does with deposits is that there is less equity that you have to have for the capital stack, which means home prices, let's say if you wanted to build a condo and it's $1 million, the current example that we have, each home would have to sell for $1.3 million for the developer and for the banks, the private equity to make a profit. Now, let's say risk is unchanged for the bank, just deposits are included. You see a price reduction of $150,000 to $200,000, so it's $1.15 million. If and we've seen cases like this from developer partners and people that we've spoken to, that because deposits are about 20% of home value, banks feel a lot more comfortable lending 80% of the product. That is cheaper debt that developers could use, and they could just use banks and the bank loans and deposits. So that home price goes down to about, let's say, $1 million. So that's a $300,000 reduction. And it helps the developers because developers will they have more security when it comes to loans and the product. But they, at the same time, have to sell these homes at a discounted rate because people are holding their basically deposits for like 1 to 2 years while construction is going to be complete. So it de-risks the product, but also lessens basically developer profit by a little bit. And it kind of cuts out sort of like private equity firms from the equation of new home construction. On the consumer protection side, let's say, a 20% deposit is a huge investment for any individual, maybe the biggest purchase that someone will do in their lifetime. These are basically bonded, so they have lower interest rates and they're protected. If the developer goes belly under, the bond issuer will find another developer to complete the project. And if the development's not on time, they get a return because everything is insured. And you could expect that insurance to pay out within 30 to 60 days, which we'll discuss more in the panel. Next slide. So the comparative analysis, we did it internationally. We also did it with other states. As you can see here, we also found that new home deposits were pretty instrumental for social housing construction. Replacing the LP in the project or the equity in the project helped make developments pencil. Next slide. So the benefits are that home prices are going to reduce. New home construction is going to reduce overall in the market from what it was expected when you had more of an equity portion of the capital stack or as large of a portion of equity in the capital stack. There's more financing flexibility. Um, this is whatever equity is gained within the home price within those 3 years. Let's say you're buying this condo for $1 million and it's actually appraised at $1.3 million. That's $300,000 worth of home wealth built for the home buyer, right? Once they lock in a price, that price is locked in. So when they purchase the home, even if the home is worth more or less, that's what the home's worth. An example of this is that I have a friend in Mexico that put down a deposit for a home that's worth $100,000. He put 20,000 down. That home is worth $150,000 now. He gained $50,000 in wealth, right? This also allows for down payments to be spread out. It's the deposit isn't a one-time payment. It could be 5%, 5%, then 10% when construction's done, which gives people more time to hold that money. There are consumer protections. It helps smaller developers with missing middle housing projects. And by building home ownership opportunities near cities, basically you are going to have more condos built or more small lot subdivisions built because those projects now pencil. Next slide. Some of the concerns is that what happens if the project defaults and bonds can't find someone that could rebuild that product? The completion rate is very high, but that's something we're going to discuss here on this panel. We're also looking at like what happens with receivership outcomes, like how is the system developed to make sure that the payments go out in order and on time. Smaller developers or developers that don't have as much experience don't have access to new home deposits. So if you've built maybe 5 projects, maybe you won't be able to bond and use deposits for your home. Like you need 20 or 25 projects that are done on time. Consumer education on protections and disclosures, and also just like how the market might change in 2 to 5 years. Let's say you put a home deposit and then the market tanks like '08. Well, you're kind of stuck with that product or you might lose the deposit. Next slide. Our recommendations are very similar to what Spur has recommended for this year with a Selling Member Reward, which what we found we go a little bit more in depth than this. The report will go more into detail, but it sort of lays out a system of how basically new home deposits could work in California. Next slide. And yeah, that's new home deposits. This is the next chapter, I think, when it comes to examining why we're not building homes for sale in California. It's the financing. There's also construction defect legislation. There's also ways of which we allow bonuses to happen when it comes to multifamily housing. And yeah, thank you for being a part of this. And I'll pass it back to Rebecca to start the panel questions.
Awesome. Thanks, Mohammed. So the first question is for Michael and Maya, whoever wants to go first. What practical financing or legal barriers make it hardest to build ownership housing in California today?
I could take that one. It is a myriad things. For one, as was inherent in the bio, Rebecca, I only build rental. And the reason behind that is that there are not enough incentives to accommodate the risk of building something for sale. And so those risks surface in the liability of builder remediation of issues for the 10-year statute of limitations, and the fact that investment is a choice. So ultimately, the folks who are investing in my projects, and for context, I'll build a couple hundred units at a time. My average project size is about 250 units. Um, I am a fiduciary for those either pension funds or high net worth individuals or private equity funds, both on the equity and the debt side. And those disparate capital structures require return. And so to justify a certain return for a certain amount of risk, it has not proven that for sale housing, in particular condos where you have stacked units, almost like a flat, have enough of a compelling back end margin for the amount of risk being taken. So that's the biggest headwind is that okay, if you're going to build something for sale, you need a margin on the back end. Are you willing to stomach that margin for the amount of liability you're taking on and the amount of dollars that you have to raise while you're delivering these units into a market that you can't necessarily anticipate? In 2005, if you started a project and it delivered in 2008, there was no crystal ball as to where the world was going to be then. So, in taking on that, for me right now, with the current structure in place, from a governance perspective, rental has been the way to go, because you can deliver into a market of unknowns and you have the ability to hold on to something because renters are ephemeral and turnover as opposed to a condo. You are a point in time and you don't have the same liability. So all of that trickles down to can you get debt and equity interested because again, investment is a choice.
Awesome.
And
Michael, do you have anything to add to that?
Yeah,
if I could add,
did you want to
oh
jump in? Did you want to jump in?
yeah, yeah, Leo, could you just stop the screen share?
Oh, got it.
Yeah, or
Great.
whoever has the part of the screen
Yeah,
share.
first
Okay,
of
there you go,
all,
Michael.
yeah, thanks. Can you hear me okay? First of all, I just wanted to commend California MB for the work on this. And LAI, when we began to dig into this, that was a place that we went right away. And Rebecca, thank you for all the research you've done on this. And also when Mohammed was at the Turner Center and with Sarah Karlinski, we began to dive into this a couple years ago because affordable homeownership opportunities is a priority for Spur in addition to all the other types of housing that we think are necessary for strong communities. And so we began to really dive in and talk to developers, and many of the same themes that Maya shared were coming up again and again in terms of obstacles to affordable homeownership, particularly in the high cost coastal areas of our state. Furthermore, we had big city mayors and housing staff saying, why can't we have a for sale product? And we do all these rentals, and why is there a disincentive, particularly in California, for condominiums? And so we began to compare with other states, Hawaii, Washington State, New Jersey, and then also, of course, great examples in Canada, which we'll hear about as well, Vancouver, for example, Ontario, and what's going on there, both with construction defect liability, but also with deposits, and how we might take some of those best practices, which we'll hear about today, and bring those into California, which will require a coalition that can move legislation to actually put us more in line with the programs in these other places, including, for example, in Tokyo. We've also heard about how that system works from developers who work in multinational levels as well as in the United States. And so those are some of the practices we've identified. As Maya has said, the 10-year statute of repose, as they call it, or the tail, creates all kinds of liability. The developers we talked to, that's 100% sure thing that they're going to get sued by before the end of that 10 years. And so that the insurance costs, and we've also done a report with the Turner Center on this as well, on those insurance costs. And quite frankly, some professionals like architects don't even want to touch condo because of that liability, or subcontractors can't get exposed in that way either. And so it's a real disincentive in California. And on the deposit side, that 3% is the maximum for liquidated damages. To go beyond that, you would have to demonstrate additional proof of damages, et cetera, which would create even more litigation, so it's unhelpful. So from the perspective of the banks, it's a 3%, and that's all you can count in California, which really does force us to much more expensive debt and equity, and excellent presentation by Mohammed on that point as well. And so what we're trying to do, and Senator Glazer last year began this with legislation, and we began to see who the opponents were to this. In terms of construction defect, particularly the consumer attorneys who benefit from this model, were opposed, of course, to changes. But also CBIA was opposed because they feel like they might get something worse if they try to reform SB 800, which is now over 20 years old. That's the right to repair law, as we call it. And that right to repair really doesn't function as a practicality. And so we wanted to create more of a true right to repair opposition to that bill. And then on the deposit side, the California Association of Realtors were vehemently opposed and claimed that we were not protecting consumers or home buyers. But as you can see there in Mohammed's presentation, we really, that surety bond is a key component of this, and to make sure that that product is built, which is also, of course, the banks are also going to have an eye on these projects, et cetera, because they obviously are financing as well. And in terms of escrow, you would just draw down those funds at various phases of construction. So you're not taking the entire lump sum up front. And so there are all kinds of eyes on this project, and to make sure it's completed, then consumers are protected. But even more, we want to make sure consumers even have access to the product, because currently we've protected the consumers so much that we can't even provide the product. So that's not working either. We just need to recalibrate, and I'll stop there with my remarks.
Thanks. Next question is for Carrie. Could you tell us how new home deposits started in British Columbia, and why did they change the rules about 20 years ago?
It's actually a great segue from Maya and Michael. And so my background is actually in construction defects and home warranty. And so I started in 99. British Columbia at that time had a leaky condo crisis. So there was a lack of consumer confidence. So, the starts back in late 90s, early 2000s was abysmal. It was very low. Really wasn't enough to supply the market. And they needed to figure out a way. And again, our warranty reform for construction defects has been excellent. And I'm knock on wood, 26 years, and the form has fit the consumer's needs and kind of the demands of the market. But when we get to '03, so in Canada, there's two major markets in my eyes. There's Ontario and British Columbia. Ontario is really the gold standard. It's a Crown Court monopoly. They run all the construction defect. They run the base of the consumer deposit protection. And, if we fast forward, 26 years from my introduction to them in 99, they have challenges and they have issues in terms of how they do stuff. But ultimately, the benefits that we saw from their market, whether it would be through how they manage warranty, but really how they manage deposits, was something that my company was really interested in. We have an active product that we do in that Ontario market, so we were very intimately involved with how the Ontario warranty system works. It's called Tarion. And we lobbied with an association in British Columbia called the Urban Development Institute. They represent a lot of the large developers, and we worked creating a framework on how deposit usage could be introduced into British Columbia. Prior to 2005, if you took $1 or you took 100% of the purchase price as a deposit, and title was still to be conveyed, that money sat in trust, sat in a lawyer's trust account with a rate of interest attached to it that could either be given to the Law Society or credited to the consumer, to the purchaser. BC created the Real Estate Development Marketing Act for the sole purpose of creating a framework and a structure that did two things. It gave a well-structured framework for a developer to be able to pre-sell condominium units into the market, and have comfort knowing that all the variables and all the things that they needed to do were addressed up front. But then on the back end, the consumer had benefits that, again, is by far less than what Michael comments about where you're at in California. But really just getting an idea that the deposit's always protected. Either they get the unit or they get the deposit back. But also too, and one of the things that still Ontario lacks, like you can market a condo project for what seems like decades, but it's really for years. So before they even put a shovel in the ground, it could be 5 years of marketing units in a condominium project in that market. We have a defined marketing term within British Columbia. You have to, if it's smaller scale stuff, so let's say non-high rise, it's a year. Or if it's like mass concrete high rise, you've got about 18 months that you need to go through that marketing phase and be at the point where you can issue, like we operate under these disclosure statements. So you present to a purchaser the development, the framework, but you file an amendment that's basically saying you're going to go ahead with the project as a developer. And that's kind of the last time within that 1 year, 18-month period that the consumer, if it's 1 year and a day, the consumer has the right to renege on their contract or unilaterally cancel their contract. Otherwise, they're locked in, and their deposit up until that point is always either in trust or covered under one of our policies, our deposit protection insurance. Why they did it is they needed a framework. We saw the financial benefit. And again, these are lending times that are by far different, a little bit more challenging in 08, 09. But for the last 5 years, you look at the spread on conventional borrowing costs, and this is conventional lending versus mezz or private equity, and the rate that these facilities are charging per annum, yeah, it's substantial. And so our goal and why we were a part of it, and why the Urban Development Institute was a big supporter of it, our goal is to find ways that we can do this business better. And that's delivering residential units in a framework. And so the warranty's always been our backstop, but ultimately deposit help by creating another avenue of working capital. And so if I showed a capital stack that Mohammed just showed to one of our developers, they'd roll their eyes and they'd fall off their chair and they'd probably never do another development again because they just don't have that capital. And they couldn't come up with it. And because, like, when I started in this business, they were selling pre-sale like high-rise condominium units for around $260 a square foot. Now, the municipal fees for that condo, if you were to build it today, are greater than $260 a foot. Not land costs, not hard costs, not marketing costs, but that's just the actual, like a CAC or like a development cost charge that the city of Vancouver would charge. So it's become more and more important for us and probably for everybody, to find ways to try and save a dollar and just to make it more efficient because everybody's trying to get their pound of flesh out of it. So
Right. Awesome. Thank you, Carrie. For Mohammed, Michael, and or Carrie, how do deposit systems function in places, well, we just heard about British Columbia, or like Hawaii, Tokyo, and what safeguards do they have that make them work? Whoever wants to go first.
But and BC is an easy one. It's, again, they very similar to even the warranty or the construction defects. It's all backed by insurance companies. So we're regulated differently. We have minimum capital tests that, no different in the US and Canada. The bigger you are, the better it is, so to speak, in terms of rating and financial capacity. All of these are dollar for dollar security. So we end up being a lender on a project, sit behind like the construction lender. We monitor construction through the process. We have tech reps that go and visit the sites. Very different, are very similar to even a typical construction lender, and we advance deposits as needed. And one of the security kind of measures within the Real Estate Development Marketing Act is the deposits can only be used for the betterment of a project. So it's not for land. It's really not for marketing. It's not for Lamborghinis to show off the stature of a site, but it's for improvements. So we do it all related to hard costs.
Cool.
So
And I would just say to be able to get that type of bond, to Carrie's point, this is a fly-by-night operation would not have the assets or the track record of success that would be required to even get this bond or to be able to pay for it. And so that's also inherently a protection in this type of a system to protect from potential bad actors who aren't going to fulfill the commitment.
And I think Maya has a solid example talking to developers in Hawaii, right? I remember we were talking about this,
Yes,
yeah, about their
actually.
capitalism.
Yeah, Howard Hughes, who is one of the oldest in the game. He's a friend of mine is working on some condos in Honolulu that are utilizing this deposit structure, and they essentially have their entire equity component spoken for by product of these condos. And I mean, there's something to be said for a very in-demand market, and there's an argument to be made that the entirety of California is in demand, but in particular, those markets that touch the coasts. I mean, if you were to talk to someone in their 20s, is homeownership a reality in coastal California? The answer is no today. If you're talking to someone in their 30s, the answer is still no, because the average age is at now 40 for a first-time home buyer. So I think it really opens a lot of doors. And obviously, from the developer perspective, while I'm not quite Howard Hughes, I think you have the ability to tout to your investors or to whomever that is backing you, either from an equity perspective, or should you need to buy into a bond or show certain assets, so that you are of the ilk that can be trusted. That opens the door for big players and medium-sized players, but regardless, it's more housing and more supply, and that's exactly what we need.
The other point I wanted to make is just about building types, which is important for us at Spur too. You will see some low density townhomes, but those are particularly in more exclusive and expensive suburbs. And we're looking for a product that could be mid or high rise in the downtowns of our cities, and that's what the mayors are looking for too. And these are the exact same buildings, whether it's a rental project or it's for sale, but the costs are just and the liabilities are so much greater if it is that for sale product, and that's why developer just decided to go the rental route. But to be able to get that type of a dense product in the places where we'd like to see it happen, we're going to have this. We're going to have to work on, for example, the deposits and the financing side to make that so that it makes sense for a developer to choose the for sale product over the rental. And obviously, the real estate economic cycle is involved in those types of decisions as well. But we're not friendly to those types of developments currently, and that's a real problem.
Yeah,
Mhm.
I think just to add to what everyone's saying, it's just that, you know, we're not building condos at all. New home deposits would help with condo construction. It would also help with townhome and single family home construction. Like it just helps everyone. You just de-risk the product. Banks are going to lend more. You don't have to go to private equity to fix your capital stack. Like private equity doesn't buy homes and wait to flip it. No, they're just a part of every housing project in the United States. And this isn't the reality really anywhere else in the world. Like everyone uses the deposit system. And if like my auntie could get new construction in Egypt and it's completely protected and it's able to be done, like they don't even have like roads, but they're able to create a deposit system that works. Right. British Columbia, I think you told me, Carrie, your biggest problem is that there's too many condos. Like there's not enough rentals. We should
Yeah.
go for more condos in California. So yeah, and it's interesting
We're
because
moving away from condos in California just being kind of this niche product for kind of a high-end product in exclusive
yeah,
areas, and making it more first-time home buyer opportunities, et cetera, and bringing it down below the median home price instead of being above it, which is, which
yeah,
is where we are now.
yeah. It's I
Particularly
remember
when
when
you
I
bring
when
the HOA fees, which is another issue that
Oh,
buyer
yeah.
will have to consider as well. And you were talking about affordability.
yeah. Oh, sorry. What were you gonna say, Carrie?
No, well, I was gonna say like the HOA fees, also known as condo insurance. So huge challenge. But
Yeah, and we speak to developer, I think West Bank Corporation. I think they're the ones that raised it to me during a construction defect webinar about new home deposits. And like they're a building in Tokyo, they are a building in British Columbia, they are a building in Washington because Washington allows a 10% deposit, all for sale housing. They come to California just because of the deposit system. They can only build rentals. They're building thousands of rentals in San Jose, and they wish they wouldn't have to. Right? West Bank is doing the Squamish Nation development of the high rises in Vancouver, and they're able to make this work because of the deposit system there. Like, this is a huge like thing that we kind of need to consider. I know construction defect is, I know it's a big topic for a lot of people, but I think deposits are that other half of the equation to make new home ownership units pencil.
Oh yeah, I mean it's bifurcated for sure. If you can take 100% of the risk and make it 50, that makes it more compelling.
Yeah. Cool. Next question is for Carrie. How many projects that you know about would you say have gone under and people did not receive their deposits back in British Columbia? And sort of what happens during booming and tough housing markets?
so because of '08 and because of current times, there's a number of projects that have gone into receivership that or they just haven't started, period, that where deposits have been returned. I've never heard of one that that has ever had legal action against deposit insurer or the developer because of lack of deposit. And again, too, unfortunately, I've been doing deposits for 20 years. I think we had one that went sideways into receivership in like 2010. And just because market couldn't bear it, the purchasers wouldn't show up, purchasers wouldn't complete on one phase, and it was the ripple effect for the subsequent ones. And then as of late, we've had a number of them where a good example. So on a Redma, you have an estimated completion date that can change if it's factual or if it's material, meaning that it's changing within, you're going to be a month later, 6 months later, a year later. All you need to do is just keep them up to date and disclose that estimated completion date. But every developer has to set a reasonable outside date. So, you know, let's reverse back to pre-COVID, and people were marketing projects and then they were forced to start it within COVID or shortly after. And a lot of the supply chain challenges, which everybody uses or everybody's heard of, and then also to just, the markets, our market's lack of ability to return to normalcy at that time through, 21 and 22 mostly. So projects, even when they came out of COVID and they launched, they still had a challenge getting to a cadence on sales and then getting a shovel in the ground that they were comfortable with. So some projects now are hitting, we have like an example, we have a 60-unit townhouse project where they've hit the outside dates. So there's a few purchasers we want out. So we're writing checks. So we're returning the deposits because the developer who's been delayed, who has budget challenge, who has partners that they're all pointing to each other. We could in their arena, we could sit and let them argue about who's going to repay, but we have an obligation. So within a 30-day period, we're going to return that deposit, and we've got security. So we've got hard security, and that's the business we're in. So we pay. A lot of situations, and again, so we've got a list of 11 projects right now where they're coming close to that outside date, and there's still construction delays that they're getting close to the finish line, but are
Mhm.
they going to be there or not? But a lot of purchasers, they're very happy being there because, again, the reason why a lot of them bought a pre-sale is they knew it was a future completion and a future asset that they got the benefit of time. So if you look at inflation over the last 4 years, it's a pretty decent growth number in terms of, what a dollar was 4 years ago to today, especially in real estate. And even with the ebbs and flows of our markets, they're still very equity and cash positive. Muhammad's example happen all the time. And
Yeah.
again, we had another project where, they they started, dug a hole, they got to a certain point, and then between them and their contractor, they had, there was contaminated soil issues from a adjacent property. Then they had some re-bidding on some of the major trades that changed. It wasn't a huge project, so they didn't gather a lot of attention through the tender process initially, but then the hiccups on having to go out and reprice some of them from some of the trades that couldn't complete or couldn't deliver, they saw a budget increase that was substantial. And so the project, then all of a sudden, as it gets delayed and has to go to refinance and all these fun things, liens occur. So next thing you know, now you've got a messy title. Well, it never went anywhere. Finally, the lender pulls the plug, receivers put in, we've got some exposure on the deposit. We pay, and the receiver sells the land. The construction lender gets back whole for the amount they're in, but we're underwater. So
Mhm.
consumers now, and I still get phone calls, and this is probably came to a conclusion about 3 or 4 months ago. They still phone me. They're not crying about anything like why did I do this? They just want their condo, even though it's such a far, out dream now. They just want their condo, and they want it for the price that they agreed to. So it's interesting. That's the market we're in. Is we're trying to help them protect that dream, but we
Are
Right.
they
just want
able
their
to get
deposit
their
back.
are they able to get their deposits back? Like,
We gave them, yeah, we gave them their deposits back. So
Cool.
How long
we
did it
made them
take?
whole, but their opportunity cost of that money, it
Mhm.
actually it waffled. The market's up a bit. They would have been in the money, probably about $100 a foot. But within 30
Wow.
days of those notices, we returned the money.
Hmm.
Mm.
Cool. Um, Thank you. The next question is for Maya. How do new home deposits fit in the capital stack for developers? Is changing deposits necessary for new homeownership construction with construction defects still being an issue?
I think it makes it feasible, depending on the construction type. So to Michael's point, I mean, the low rise stuff, the cheapest thing to build is a single family home that's one story. That's whatever, less than $200 a foot. As you're introducing more and more concrete, as you're getting closer to a downtown core where the product type wants to be a taller building, that ekes into the sometimes closer to 500, $600 a foot. So to recoup those costs, you have to justify a back end purchase price that allows you margin to return capital and then some. So every dollar that you take to construct that building at, call it $600 a foot, costs you money. For the bank, maybe it's a spread over an index. For the equity, it's an expected preferred return, and then you're sharing your profits with them. So that portion is what is directly supplanted with deposits. So deposits against which you can borrow so that you can say maybe this is a $100 million project, perhaps 30 million is coming in early by product of these deposits. The bank says, okay, great. Well, it's a de-risked deal because you're not speculatively building for buyers that may or may not exist in 3 years. And you are taking, you still have some of your own money, you have skin in the game. That's great. So maybe I'm willing to lend you more than what I would be if it were a spec build. So maybe I'll lend you that 70% remaining, or maybe I'll give you 60, and I would normally give you 45 or 50. So that's where it comes into play, because what you owe the dollars that come in as deposits isn't profit share. You owe them a house, and the inherent appreciation of that house they get to capitalize on. But as a developer, all I care is that I built the thing on time, I built the thing on budget, I'm able to give the bank back their dollars, I'm able to make a little bit of margin, and people got housed. So that's where it fits into the capital stack.
Awesome. Thanks. We have a few more questions, so I guess I just want to remind the panelists, like, maybe try to keep the answers a little bit shorter so we can fit everything we want in. The next question is for Michael. Why is California's new home deposit system not working? And what would a California specific reform look like?
Yeah, so it's that 3% liquidated damages, that limit that really is different than all the other examples you're hearing from Canada and other states that we want to change that and become more comparable. We really, British Columbia has both on the construction defect side as well as the deposit side has become a model that we've looked at. Our friend Derek Sagehorn from East Bay for Everyone has done a lot of work too on that warranty system and thinks that we need to maybe even if it's just a pilot to start that, and then if we bring in the a deposit system and the surety bond and we convince people we've got examples here where this works and that consumers are not at risk, then we could really start to move a for sale product like never before in California. That's really our goal, I think, going forward through the legislature. And so we need to build an educational movement here, and that's what we're doing in a coalition that can help support that and overcome opposition, but also explain how we care about consumers too. We want to be homeowners as well, many of us, and we wouldn't want to be at risk and lose our down payments or our deposits, earnest money, if you will. And so we understand that and get that, and we're not at all ignoring that aspect of this challenge.
Thanks. For Carrie and Maya, from a co consumer or policy perspective, what do you think is needed to ensure buyers remain protected? Just briefly.
I'm just a big like I love the framework. Like legislative framework is all they need to get that comfort because government will never take advantage of a consumer. So, but they've got to be fair to to both sides.
Hmm.
Yeah. I think the perception battle might be that people think, hey, I'm giving my money before a house exists. Who's saying she's not going to go buy a Ferrari? And that who ought to be the government. And there has to be a very, very clear framework, and almost advertising campaign, I think, on that behalf.
Hmm. Cool. Next question for Michael and Mohammed. Why is there opposition to expanding new home deposits in California?
I think people are just worried about, I mean, there's two things people hate, right? Like the status quo and change. And we're kind of on the field of which we don't really like the status quo because we don't really know a lot of homeowners, and I aspire to be one day. And people are worried about like, okay, if we maybe loosen consumer protections a little bit, like that might hurt people. Like the worst thing that the government can do is hurt more people, especially in today's times. I think the purpose of this paper is to show, and this paper will be released by the end of the year, and this panel is to show that there are mechanisms to ensure that people are made whole. Like Carrie's example earlier was like, oh, people are complaining that they're not making an extra like $100 square foot, they're getting the whole deposit back. Yeah, they still get their whole deposit back. And in Europe, you could sell your deposit, like your stake in a building. You're like, oh, I could actually make a profit and I could sell the stake, right? I'm not proposing this in the California system, but it's like, it's totally just a, you know, human beings have been building cities for thousands of years, like 5,000, 6,000 years. As an Egyptian, I have the right to say that. And they had financing mechanisms like deposits and maybe like banks to like help like spur this sort of construction. It's just interesting to me that when we were looking at these examples, Rebecca, around the world, there were two things. Number one, it was so common, there's just no academic research behind it. Like it's just such a normal thing. And number two, the United States is the outlier here. Like it's one of the few countries, if any, that does not allow the system to proliferate, where basically you're limited at that 3%. It's not used for construction. And we have to ask why. Like this was passed in 1978. People used to run away with their like developers would be like, oh, I got all these deposits and I run away. But now we have like computers and escrow, and we have like all of these like systems in place that can actually protect us. Maybe we could loosen the valve a little bit so construction can happen. But I'll pass it to Michael for his insight.
Nothing to add. Perfect. Thank you.
Um, Great. Also for Michael, how does this system benefit new home buyers? How much more affordable are homeownership units with the new home deposits?
Yeah, well, it gives them access to a product they currently don't have access to, number one. But I think it, you hear about luxury condos and all that kind of a concept, and it's really pied a terre, whatever they call them in San Francisco or something. That's the kind of product that we're able to create, or Beverly Hills condos or something like this. And we want to move this to a more broad, affordable home ownership, which really brings it, like I say, below that median home price. So we're in six figures instead of seven, and the reductions could be significant, 20% or more. And Carrie and Maya probably have the exact numbers on those, but that's the movement we're trying to make. So this it's a broader access to affordable home ownership, which is what I think our younger people want, and they want to be able to stay in this state and then actually, live in these metropolitan areas, but also have an opportunity for home ownership, and that's our overall overarching message on this.
And and if I could add, I think right now what we have in the United States, but specifically California, is just like the scarcity mindset, right? Like we're seeing like 10 people bid up the price on like a 2-1 in Berkeley that was like for $1.2 million, which is atrocious. And now it's $1.75 million and
Mhm.
it's sold. And then now there's 9 people that are still looking for homes in the housing market and hoping, someone might possibly pass away in their home so then they have a chance of buying a home for ownership, right? Like this is the Berkeley model, right? People leave. And like what deposits do is sort of like everybody can come together, pitch in money, and build this new housing construction. And you can customize the home. Like you don't have to go in and then like flip and change all the carpets and the tile. And like you kind of have like that first say of what you want that home to look like, not like change orders. Like I think the developer will have like set systems of which they'll say, oh, you want granite? Okay, you can put granite is this additional cost. Oh, you want you want this paint color inside? We could do that, right? Like we could create more creative, fun homes, more people could have access to home ownership. And it's like the average down payment right now in California is like 18.5%. And like just allowing it up to 20%, like we're gonna take out the pressure on a lot of on a lot of the market and focus it towards new supply rather than focusing it on existing housing stock. Because when there's a lot of people that want to buy one home, that it's a recipe for like sort of gentrification, corruption, displacement. Like you have a lot of pressure because there's a limited supply. This would just allow us to build more homes. And at the same time, these deposits are split out during a 1 to 2 year period, right? 5% here, 5% there, 10% at construction. You could save up during that time. And you could pair it with these, someone brought this up in the questions, with these state programs that help with first time home ownership. So instead of moving people to the front of the line, like what we're doing now with the Dream for All program, where it's like, here, you won the lottery, you get that 20% down. We're going to be like, okay, maybe we could use that money for new housing supply. And I think that just changes the paradigm of what we're used to in California.
Mhm. Cool, thanks. Our final question for Michael and Mohammed, and I guess Carrie or Maya, if you have anything to say as well, feel free. But how could new home deposits benefit community land trusts, social housing, and on other alternative housing models?
Yeah. So, like, this is something I wish we put in the paper. In 1978, when we limited deposits, we kind of just saw this like rapid decline of like co-ops and community land trusts. New home deposits was a way to actually fuel construction of these alternative housing types because all you need is a bank loan. You don't need like a private equity firm that's like, oh, I don't want a community land trust. There's kind of more power in the people to put down a deposit and use that money for construction. So you're going to see like sort of an increase of co-ops, community land trusts, and people that could afford it for new construction that we wouldn't have seen before. And I think I stated this earlier. I was speaking with Paul Williams about this, known in the housing finance space, and I want to dig into it a little bit more in another paper. But like the social housing program in Singapore, in Vienna, like these work because of new home deposits. Like they're a part of the capital stack, and and I know California is through SB 555 is having a study bill on social housing. Um, this is a part of the equation that it's overlooked because it's so common everywhere else. But to replace the LP when it comes to this sort of mixed income housing investment, especially when you're going to build for middle income people, you need like these new home deposit systems. You possibly need these new home deposit systems. And I think that's like another topic for study that I would love to see in the space is like how new home deposits could open up alternative housing models that we don't see in the current market.
Hmm. Awesome. Oh, Carrie, did you want to
I'm
say
only
something?
going to add one thing is that when you make development easier to happen, you can add more variables like, multifamily and faceted development include, accessible, affordable, it's almost like community benefits can actually be like lower cost housing components that typically a developer wouldn't be, excited about doing in the sense that there's not a lot of profit to them. But if you make a development easier, like we have it here, City of Vancouver has a component where you have to build, kind of a lower spec or a lower level unit as a percentage of your total unit count in order for it to fly. So there's a lot of variables, but when you make development easier, you can add more components and community like amenities to it. So just because you're saving some costs
Cool.
and supply and demand. The more you
Yeah,
supply to match up the demand, the pricing is going to change. So hopefully.
right. So we actually have time for one question from the Q&A. So I'll ask Abdullah's question. What is the relationship between home deposits and loan ratios? Will a bank be willing to lend a higher loan to cost LTC if they see a deposit as part of the capital stack? If so, will an increased loan size affect the lender risk, i.e., they may charge a higher rate? If anyone has an answer to that, feel free.
The typical capital stack that we saw prior to deposits being used is probably a little bit more favorable than what Mohammed showed, where we wouldn't see equity to that level, to that 20, like 25% was very common. So we've seen a reduction in the equity component because again, there's a deposit component within there. So lenders actually through this whole process, they were very pessimistic, but they didn't want equity to disappear, and it hasn't. It's just actually been enhanced with deposit use. So their loan to cost, but really loan to value has reduced. Like, we believe that their portfolio is purified a bit by the use of deposits. And again, it's that sure revenue number, like 3%, like that, it's unimaginable that, a developer would actually, offshoot benefit to a purchaser for a 3% downside for them. I'd be buying those all day. And again, we have a lot of purchasers that would be interested here, where we see 10, 15, 20, 25% deposit levels, those just help reduce that loan to cost.
Hmm. Thank you.
Oh wait, what do you think oh wait, first of all, Carrie, right now loan to values are much lower, so equity is a much larger part of the capital stack when it comes to California. I know this was Canada like 20
Normal.
years ago.
Yeah.
Yeah, I know. Um, Maya, what do you think of the question? Because I don't think it was.
Yeah, yeah. I mean, for reference, I have a 270 unit deal under construction, and I'm 50 on debt. So it's a 50/50, and that's as good as it was going to get. This was May 2023, so times are, I think, a little looser, and spreads are a little tighter. But I think it would be a I think it would be an internal weighing of speculative versus surety. And to a bank who thinks about things 10 times more conservatively than I do, if I'm underwriting rents at $1, they're underwriting them at 50 cents. So they need surety. So if you can prove that someone wants to live here so badly that they put their deposit in, that's a level of surety that we currently do not have. And even on multifamily, you cannot necessarily prove beyond looking at comparable assets that people are living in that demand exists. So I think that the LTC, the loan on cost, would appreciably increase. I'm not sure that there would be a commensurate increase in the pricing of that facility, but I think that you would be able to fill more of the test tube that is the capital stack with debt.
So like LTC would go up, or no, it would be LT.
Yeah,
Yeah, and then LTV
yeah. Like
would be the same.
if I had deposits and I were building these 269 units as for sale, and I could say, hey guys, I've got, 20% of the overall project cost is in the door. People are excited to live here. The bank might say, that is awesome. I will take the other 80% because I don't think the 100% of the people who gave you 20% are going to walk away.
Mm, okay, perfect. So it increases LTC, but doesn't increase LTV. It increases both. Sorry, I'm confusing the two terms.
The value, but the thing is the value on the back end, like if the value on the back end is captured by the home buyer. Because if I'm selling you, these are simplistic numbers, but if I'm saying, okay, I'm going to build this project for 100 million and I'm selling out at 120 million, and good news, it's worth 140 million when it delivers, like I don't get that
Mhm.
extra 20 million, you do as the buyer. But I'm totally cool because I performed on my business plan. And the bank is totally cool because, all's well that ends well. So that LTV doesn't actually even matter. The LTC is
Mm,
where they're evaluating that risk.
perfect. Thank you.
Thanks. So to wrap up, I'll just say a few last words. Our goal isn't to pick winners or villains, it's to understand how other systems enable construction and ownership at the same time. California can learn from those examples and build a framework that balances innovation with accountability. Thank you to all attending this event and to our panelists for their insight. Please subscribe to our newsletter, The Homework, to stay up to date on the release of our paper that will show how California could reform new home deposits. This will be on YouTube to share too. So see you soon. Thank
Great
you.
stuff. Thank you all.
Thank you.
Thank you.
Bye.
Oh, and Leo, copy and paste the questions so we can follow up with them.
Yeah, actually, you already done that.
Perfect. Perfect. All right. Awesome. Thank you, everyone. Great job, Rebecca.
Thanks. You too.
All right, thank
Yeah.
you. All right, goodbye.